Today, we will briefly discuss the background of our study on corporate financial performance, focusing on trend and comparative analysis. Corporate financial performance analysis is essential for understanding how companies operate, grow, and sustain themselves in competitive markets. It evaluates a company's financial health by examining profitability, resource management, liquidity, and solvency. This analysis relies on three key financial statements: the balance sheet, which shows assets, liabilities, and equity at a point in time; the income statement, which reveals revenues and expenses over a period, indicating profitability; the cash flow statement, which tracks cash inflows and outflows, highlighting liquidity. Using these statements, we apply analytical techniques such as trend analysis, which compares financial data over multiple periods to identify growth patterns; comparative analysis, which benchmarks a company's performance against peers or industry standards; ratio analysis, which evaluates relationship between financial items to assess profitability. The Malaysian property sector has evolved significantly over the past several decades. It began in the 1960s and 70s with mass housing projects aimed at accommodating a rapidly urbanizing population. As the economy grew and incomes rose, demand shifted towards higher quality homes, condominiums, townships, and commercial spaces. Throughout the 1980s and 90s, the industry matured, overcoming challenges like financial crisis and policy changes. Yet, it remained resilient and central to Malaysia's development. From 1990 to 2019, property transactions more than doubled, driven by economic growth, population increase, and the desire for home ownership.
IOI Property was established in 1975 as Lam Sun Huat Development Sdn Bhd before change its name in 1994. It's listed in Bursa Malaysia in 2014. The vision for this company is trusted being consistently adapted as core value for the company, such as trusted to innovate and trusted to build confidence. Several key developments of IOI Property including Bandar Puteri in Puchong, IOI Resort City in Putrajaya, and Bandar Putra Kulai in Johor. IOI Property also supports conversion to sustainable lifestyle by installing eco-friendly features in their residential projects such as solar panel installation and bike-friendly lanes as greener transportation alternative. They also ensure that their investment properties adhere to ISO 9001 and Green Building Index. And also they ensure that their building construction are according to classic system.
DARBY Property Berhad stands as one of Malaysia's most prominent and also long-standing property developer. In 2017, the company took a major step forward to becoming a public listed entity on the main market of Bursa Malaysia following a strategic merger from DARBY Berhad. Today, DARBY Berhad holds one of the largest land bank in the industry with approximately 2,800 acres of land. Among its signature development are townships that have become household names Subang Jaya, Ara Damansara, and also City of Elmina. The group is also actively engaged in industrial and logistic real estate. Committed to innovation and sustainability, DARBY Property designed eco-conscious, community-centric development that integrates smart technology, green space, and sustainable design principles. The company also embraces digital transformation and for strategic collaboration. Okay, liquidity ratio. This ratio measures a company's ability to pay off its short-term obligation using the most liquid asset, those that can quickly be turned into cash. It helps us to understand whether the business can comfortably handle upcoming expenses like bills, payrolls, and other short-term liabilities. Generally, the higher the liquidity ratio, the better. It means the company is less likely to face cash flow problem and is in a stronger financial position to meet immediate needs. Next, let's talk about the current ratio. The ratio tells us whether a company has enough current assets such as cash, inventory, or money owed by customer to cover its short-term debts. It is a key indicator of the company's short-term financial health. Alright, so last but not least, a quick ratio, also known as the acid test ratio. This ratio shows how well a company can meet its short-term debt using only its most liquid cash, like cash, bank balance, and money owed by customer, unlike the current ratio. Let's begin with the current ratio, which measures a company's ability to pay off its short-term ability with a short-term asset. So for SIME DARBY property, we observe a gradual decreasing trend over the 5 years period. The ratio fell from 1.39 to 0.79 in 2024. This is a consistent decline, cites a growing pressure from increased current liability despite a slight rebound in 2022. In contrast, IOI property experienced a fluctuation trend. After a stable position in 2020 and 2021, the ratio dropped sharply from 2.06 in 2021 to just 0.26 in 2022. Now, we are going to be moving forward on the quick ratio, which excludes inventory from the current asset for a more conservative view of liquidity. So, SIME DARBY property again show a declining trend from 2.36 in 2020 to 1.42 in 2024. The consistent drop reflects increased current liability and possibly slower conversion of receivable into cash. For IOI property, we see a volatile pattern. The quick ratio plunged dramatically from 3.11 in 2021 to just 0.47 in 2022. Again, it is indicating a liability surge. Okay, now let me walk you through the liquidity ratio comparison between SIME DARBY properties and also IOI properties group BERHAD over the 5-year period from 2020 to 2024. So, firstly, we will go through to SIME DARBY. SIME DARBY show a consistent downward trend in both current and quick ratio. The fall in the current ratio from 1.36 to 0.79 and in quick ratio to 2.39 to 1.42 highlight a tightening liquidity position. This may be due to an increase in current liability. Next, IOI property, it shows a volatile liquidity position with a sharp drop in both ratio in 2022. The current ratio improved to 4.63 and the quick ratio jumped to 4.95, suggesting the better liquidity control and possible asset restructuring.
Leverage ratio is used to evaluate the percentage or degree that a firm using borrowed capitals to finance their company's operations and assets. Debt ratio is used to measure the amount or percentage of total assets being financed by debts of the firms. Formula for debt ratio is total liabilities divided by total assets. Meanwhile, times interest and earn ratio is used to measure the ability of a company to pay the interest charges for debts incurred. And the formula for times interest and earn ratio is earning before interest and taxes divided by interest charges. And now we are analyzing the debt ratio for both SIME DARBY properties and IOI properties. As shown on the table, SIME DARBY properties had displayed a decreased trend for their debt ratios over the years, with a slight increase to 38.87% in 2021, but it had decreased steadily since then, with the latest ratio of 36.48% in 2024. Meanwhile, for IOI properties, it shows an increased trend for their debt ratio, started with 41.79% in 2020 and ended with 47.27% in 2024 due to a higher liabilities incurred by the company. And now we are moving to analyze times, interest and earn ratio for both companies. As shown on the table, SIME DARBY property had displayed an increased trend over the years, started with a negative number of negative 11.39 times in 2020, but had grew positively to 12.24 times for their latest ratio in 2024. This is contributed by the growing of EBIT's profit to 737 billions in 2024. As for IOI property, the trend is showing a fluctuating trend. It started with 6,050 times in 2020, but dropped drastically to 31.34 times in 2022 due to higher interest charges of 34 million on that year. As for the latest ratio, It shows an 119.83 times in 2024. Upon comparison of leverage ratio for both companies, we conclude that SIME DARBY performed better than IOI Property. SIME DARBY maintained a lower average debt ratio than IOI Property, which is 37.04% versus 45.05%. Even though IOI Property displayed impressive TIE ratio, which is 2017.7 versus 3.18 times, their trend is actually fluctuating and showing a declining rate over the years, in contrast with SIME DARBY TIE trend, which is increasing.
Hello everyone, I'm KHADIJAH binti AKBAR, and I will now continue the presentation by discussing the activity ratios, which play a crucial role in evaluating the company's operational efficiency. So, activity ratio, specifically the average collection period and also the inventory turnover ratio, both of these ratio will help us assess how effectively a company manage its receivable and also inventories. So, to put it simply, these ratios will show how well a company is converting its working capital into a revenue. So let's begin with the average collection period. So here, the ACP will measure the average number of days it takes for a company to collect payment from its credit customers. So a shorter ACP indicates the company is collecting payments more efficiently, which contributes to a faster cash conversion. So this is especially important for maintaining liquidity and also supporting day-to-day operation. Okay, so next we will look at the inventory turnover ratio. This ratio will show how many times a company sell and also replenish its inventory over a period. So a higher ITO will suggest efficient inventory management, meaning the product are moving more quickly. And on the other hand, a lower ITO could point to issues such as like overstocking or maybe a slower sales, or or maybe also a weak inventory control. So to sum up here, both ACP and also ITO are the key indicators of a company ability to manage its operational resources efficiently, and also they are directly impact the company's cash flow and also financial health. Okay, so now let's take a look on the average collection period or ACP. So as I mentioned earlier, this ratio will reflect how quickly a company collects payment from a customer after sale on credit. So looking at the chart on the left, we can see a clear contrast between the performance of SIME DARBY property and also IOI properties from 2020 to 2024. So SIME DARBY, as shown in red, they have started off with a relatively long collection period, peaking at 115.61 days in 2021. So, but however, the company show a steady and consistent improvement year after year. So by 2024, the ACP has dropped significantly to just 55.71 days. So this downward trend suggests that SIME DARBY has made a clear improvement in their credit control policies and receivable collection process, which helping it convert sales into cash more efficiently. So on the other hand, IOI properties represent in blue. They started off stronger in 2020 and 2021 with the shorter ACP of 66.75 days and also 59.65 days respectively. However, this performance was not sustained, and as you can see in 2022, the company experienced a sharp spike of ACP up to 147 days, which suggesting delay in efficiency in collecting the payment from customer. So although IOI improved again in 2023 to 50.77 days, the figure rose one more time in 2024 to 71.71 days. So this pointing back into the inconsistency in their credit management approach. So in summary, while IOI had a lead in the earlier years, SIME DARBY clearly outperformed over the 5-year period by showing consistent improvement and also ending with much stronger ACP. So this reflects better financial discipline and also more efficient working capital cycle. Okay, next, let's move on to the inventory turnover or ITO, which help us on understand how efficiently each company manage and sell its inventory over the period. So looking at the chart here, we can see that some Derby property shown in red, they consistently outperform IOI properties across all 5 years. In 2002, in 2021, Sam Derby had an ITO of 0.86, and this improved steadily up to 1.40 by 2024. So this positive upward trend suggests that the company has been managing its inventory more efficiently, likely maybe through a better project planning, a quicker sales execution, or maybe a faster inventory movement. So a higher turnover here is a good sign basically, as it also indicate a strong demand and a few holding costs. So now turning into IOI properties, represented in blue. So the company started from a much lower point, just 0.41 at 20, in 2020, while it has made a progress reaching up to 1.0 in 2024, it still lagged behind Sam Derby. So the improvement here is encouraging, and it shows that IOI is moving in the right direction, but it suggests that there is still a room for a better inventory and also project management. So to sum up here, Sam Derby not only maintain higher turnover ratios throughout the period, but they also demonstrate consistent improvement, which reflect a stronger operational execution. While IOI properties, although improving, but they are still they are still continues to trail behind.
Okay, next is profitability ratios, which are financial measurements used to evaluate how well a business can generate profit over a specific period. There are three key ratios. First is return on asset. Return on asset measures how much profit a company makes in relation to its total assets. It shows how efficiently the company used its asset to generate profit. Next is return on equity. Return on equity shows how effectively a company uses investors' money to generate profits. A higher return on equity indicates that the company is managing shareholders' investment well. Lastly is net profit margin. This ratio tells us how much of the company's revenue becomes as net profit after deducting all expenses, which is tax, interest, and other costs. A higher margin means the company is more profitable. These three ratios are important measurements of a business profitability: the profit, cross-company performance comparisons, and long-term financial health management. Profitability ratios comparison for Sam Derby and IOI properties. Sam Derby has a much higher return on asset compared to IOI property over the past 5 years. Sam Derby's return on asset range from 11.79% to 22.55%, showing strong and consistent growth in how well it used its asset to make profit. However, IOI property has a much lower return on asset, between 4.59% and 5.84%, with minimal improvement. This means Sam Derby is more efficient and successful in using its asset, making it a more attractive company for investors. From 2020 to 2024, Sam Derby consistently had higher return on equity than IOI properties. Sam Derby return equity keep growing, showing strong and improving profitability. But IOI properties had much lower on return on equity, with little improvement over time. In 2024, Sam Derby return equity is 36.30%, was almost 4 times higher than IOI properties, which is 8.92%. This means Sam Derby is better at using its shareholders' equity to generate profit, making it more appealing to investors looking for higher returns. From 2020 to 2024, Sam Derby had a higher and more stable net profit margin than IOI properties. Sam Derby maintained an average NPM above 86%, while IOI properties NPM decreased from 77.29% in 2020 to 73.26% in 2024. This shows that Sam Derby is more efficient at turning sales into profit and is improving over time.
Overall, SIME DARBY is the stronger company in terms of profitability.
Okay, so to wrap up our analysis, let's take a look on the recommendation and also conclusion. So based on the overall financial performance over the past 5 years, SIME DARBY Properties stand out as the more financially solid and also reliable company. So this is supported by a strong profitability indicators such as high and stable ROE, and also net profit margin, all of which point to the company's ability to consistently generate return and manage costs effectively. In terms of operational efficiency, SIME DARBY has demonstrated a solid improvement. It has reduced its average collection period significantly, indicating the faster receivable collection, and also has maintained the better inventory turnover compared to IOI properties. So this improvement reflect a stronger control over daily operation and also a smarter resource management. On the financial management front, SIME DARBY continues to maintain a healthy low debt ratio, which show that the company takes a more conservative and disciplined approach when it comes to borrowing. Which okay, while there are some liquidity challenges, the company still show a stable growth and effective risk control with a fewer fluctuation compared to its competitors. So on the other hand, although IOI Properties has shown a recent improvement in liquidity and also strong interest coverage ratio in earlier years, its performance has been more volatile. So it faces rising debt level and inconsistency in profitability and also efficiency, which raises concern about long-term sustainability. So in conclusion, Sam Darby Property emerged as a better performing company. It offers a more balanced and sustainable financial profile, giving a greater long-term confidence to the investor and also their stakeholders. Thank you so much.